What is a discounted cash flow? Well, discounted cash flows are tied closely to the concept of the time value of money. And the time value of money says that money now is worth more than money in the future. So a discounted cash flow is the present value of a future stream of cash flows. So it tells you how much future amounts of cash are going to be worth right now. And so a discounted cash flow is calculated in almost the same way a present value is, because it is a present value calculation, but since it's the present value of multiple different cash flows that are coming in at different times, you have to calculate them separately. And this is because the discount rate changes and it often increases as time goes on. So for example, in this calculation, we have our initial cash flow, and we add to that the cash flow in period 1 over the discount rate in period 1 raised up to the first power since it's the first period. Then we add to that the cash flow in period 2 over the discount rate in period 2 raised up to the second power because it's the second period. And you add all of the periods, all the cash flows from all the periods together with their individual discount rates, and that's how you find the discounted cash flow. So I'll demonstrate this with a quick example of cash flow that spans 2 years. And so in this example, we're going to hypothetically be starting our own business. So let's say that this business takes $10,000 of initial money to start. So we have an initial cash flow of negative $10,000. But let's say we estimate that our net income in year 1 will be $5,000 and our net income in year 2 will be $10,000. Now the discount rates in year 1 and year 2 are different, and this is often the case in practical matters when you're dealing with discounted cash flows. So in year 1, we'll say that the rate of return is 5%, and in year 2, we'll say that the rate of return is 10%. So you plug all of those numbers into the calculation on the previous slide. So we'll have negative $10,000 as the initial cash flow. And then for period 1, we have to discount whatever cash, the $5,000 that we're bringing in. We have to discount that by the 5% discount rate. So we take 5,000 and divide it by 1 plus 0.05. So 5,000 divided by 1.05. And then we raise the 1 plus 0.05 to the first power, so you don't need to worry about the exponent in year 1. But then in year 2, we have the cash flow of $10,000, and we have the rate of return, the discount rate, is 10%. So, and remember, the discount rate is the rate that we could invest our money at. Oftentimes you use the risk-free rate, but it's the rate that you could invest your money and gain from that if you were to invest it right now. So that's why it's important to discount it, and that's why it's called the discount rate. So anyway, so we have the $10,000, and we put it over 1 plus 0.1, because our year 2 discount rate is 10%. That's why we have to do 0.1 instead of 0.05 from year 1. And we raise the 1.1 to the second power. So we divide 10,000 over 1.1 to the second power. And once you add all of these numbers together, so all 3 numbers that you get from this calculation, you end up with a discounted cash flow of $3,026.37. So you can see it's quite different from just, well, $5,000. I mean, you could look at these numbers and say, well, the business is going to make $5,000, but it's not, because the time value of money is very important, and it's also important to realize that discount rates increase over time, so earning the most money in year 2, that money is actually worth a lot less than $10,000 right now. So if you have any questions, please leave them in the comments section down below. Don't forget to subscribe to the channel for more finance-related tutorials and videos, and like the video if you learned something, and thank you for watching.